Hi, this is Morgan Smith. I am an advisor and partner for WorthPoint, a wealth management firm. And I'm here with my special guest, Apollo Lupesco, Vice President at Dimensional Fund Advisors. Hello, Apollo. How you doing today?
Hey, Morgan. Good. How are you? Good to see you again.
Yeah, long time no see.
We're back.
So this is a continuation of a series that I am doing with my special guest for perspective, Apollo. And it's the top 10 investing myths. And we're doing this as a series. And so, what we'll look at in this video is myth number six, and that is inflation hurts the stock market. Now, today is, as a recording, is June 6, 2023, just for perspective. And obviously, we've had a lot of inflation lately. It's picked up significantly. And I think most people are feeling it in their pocketbooks and at the gas pumps and energy bills, you name it. And interestingly enough, I did a video for my clients, and I referenced an article here. Will inflation hurt the stock market? Not necessarily, and coincidentally published by Dimensional Fund Advisors. I thought that was a neat publication and referenced some information from Fred. But I was kind of surprised as I kind of dove into these for this messaging. As gee, is during times of inflation, the stock market might actually be the best place to be.
Right.
So, going back to the myth here, will inflation hurt the stock market? Apollo, what say you?
Well, it is interesting because as inflation popped last year and it got higher and higher, a lot of folks are concerned that this cannot be good for the stock market. And as you said, we've looked at this from more rigorous research perspective and asked that question: How is inflation related to potentially related to stock market returns? And the first thing that we did, and which is obvious, is look at the data, look at year by year, what has been the inflation rate in the US and how does that compare with the stock market? Is there a clear, visible trend in that particular exercise? And what was interesting is that when we looked at the data and we went back about 30 years or so, this is what we found. What you see in yellow here is the inflation rate for a particular year, and the blue bar is basically what the stock market did, being the S&P 500 index in that particular year. So the first thing that kind of jumped at me was that it does not appear there's a clear connection here, that when inflation is high or low or zero for that matter, that necessarily tells us much about what the market's going to do. Because you have a year like in this year in 2019 98, when inflation was very similar to was in 99, very similar to what was in 2000, and we had vastly different market returns. So to me, when I look at this, there's not a clear evidence. There's something clear that tells me, hey, when inflation is going to be, a certain range, a little higher or lower, that necessarily will impact the stock market. But Morgan, what's interesting is that people were saying, okay, well, that's when we had some sort of a more normal inflation. But what about when inflation gets to be pretty high? Does that principle still hold? And we looked at this, and it's really interesting because we have about 100 years or so, going back to 1927, of data when it comes to economic data, going looking at inflation and the stock market for that matter. So what we did is we took all the inflation years, going from the lowest one, which Morgan happened to be in the 1930s, and it was a negative 10% deflation. That was the lowest. It wasn't an inflation year; it was a deflation, meaning the prices dropped by about 10%, which is a bad thing because a lot of businesses that have loans, they don't generate enough revenue because now the prices are dropping by about 10%. So this is a very bad case scenario. That was the lowest rate. And then the highest one, it was up to about 18 or 19. And do you happen to guess what year we might have seen that the highest inflation rate in the US?
I'm going to say that
Any guess?
the year it was 1980 something. I'm going to say, or
Yeah,
maybe
that's what I thought initially too. That's right, because like in the 70s, the 80s, it turns out that the highest inflation rate was in 1946, which is a year
aha.
after the war. And partly might have been the reason we saw such a huge inflation in 1946, even as the war was over, is partly because for years we had this thing called the Office of Price Administration, or the OPA, that basically regulated prices in the country. And as you let that go and you release that valve and prices go back to market prices rather than being forced down, then you see higher inflation. But we had this range of a negative 10% to plus 18%. And the average has been about 3%. So about 2.6% of the time, 2.6% being like half the years have been below, and and half the years above 2.6%. So there is inflation. That we have seen inflation in the country, and what we did is, once we sort all these years from the lowest to the highest, we cut it in half and we discarded the lower half, just because we wanted to see how the stock market behaves when you have above median inflation. And for a stock market perspective, the idea is, does it stay ahead of inflation? Does the stock market actually give you returns above and beyond inflation? Those are called real returns. So if you hear the word real returns, that is above and beyond inflation. So we wanted to see what was the performance of the market above and beyond inflation for those above median years. And initially, like, my economic intuition would tell me that that the stock market is actually a good place to stay ahead of inflation, because, listen, or to keep up with inflation, because if the toothpaste goes up and prices go up, who's collecting the additional revenue? Well, it might be a company that is part of the stock market, so they're collecting a great revenue. Their value might increase. So conceptually, the stock market's actually not a bad place if there's high inflation, because, again, who's charging these higher prices? Companies that are likely, a lot of these companies are likely part of the stock market, so their revenues increase as prices go up. So we did that exact exercise, and we looked at what happens to these above median inflation years, and this is what we found. What we found is that if you go back to 1927 to 2021, and you look at the stock market as a whole, what you got as an investor is you got inflation back plus 5.1% on top of it. So this is so interesting, because what it tells us is that that as an investor in the stock market, not only that you stayed ahead of inflation, you got inflation, but you also captured about 5% on top of it. And this is in the years with above median U.S. inflation. So these not all years. We specifically looked at the higher inflation years. Which is, again, really encouraging, and it's kind of suggesting that you can actually stay ahead of and outpace inflation just by participating in the stock market. Now, within the stock market, there are different groups of stocks, and we have the large tech. Typically, are part of a group called large growth. These are large, mature, well-established companies. And when you look historically, what you see is that the large cap growth have also delivered inflation back plus 4.4%. So not quite as much as the market as a whole, but certainly you still outpace inflation. But what's also very interesting is that investors diversify from large to small and from growth to value. And you look now, instead of large growth, you look at small value. What's fascinating is small value basically has delivered inflation plus 12.4% on top of it. So to me, I think that what the data seems to suggest is that if you're invested in the stock market, you can outpace inflation. You can stay ahead of inflation, and it's actually not saying that inflation is necessarily good for the market or bad for the market, but the stock market is keeping up with inflation and delivering something on top of it. So again, it's the myth that inflation is really bad. When you look at it, inflation doesn't seem to be related to stock returns. Secondly, conceptually, the stock market is actually a good place because companies in the stock market are the ones collecting the extra revenue. And the third point is that when you look at the data over the long run, even if inflation is above median, you can still get inflation back in the stock market and outpace it by a quite significant amount, and even more so if you diversify beyond the large companies in the market.
Boy, I really love the perspective looking back in history. I mean, I think the more we know history, the more we can understand things. And my three takeaways from this: one, from the investment standpoint, when I look at investment portfolios of folks that aren't clients of mine, typically they're more weighted towards large and growth. And I think some of the data you're showing for real returns, you want to make sure that, look, it probably makes sense to have some tilt and exposure to small value more so than many investors might be. My other takeaway as a financial advisor is this idea of, when you do a financial plan, all this stuff is really important, because what we want to do when we do a financial plan is build in an inflation rate, because we want their money moving forward to sustain their lifestyles above and beyond inflation. And so that's really important from a financial planning point. And it was to my point earlier on an earlier video, is that financial planning is the core of what we do, but the investments are very important. Well, good. Well, let's look at this again. I think the question for today's video, myth number 6: inflation hurts the stock market. And I think the obvious uh, message here is that that's not necessarily the case. In fact, over time, it looks like there's many cases where you can build a portfolio and get a return and above and beyond inflation. Apollo, very much uh, appreciate the history lesson here and the insights on this. Thanks again. Again, my name is Morgan Smith. I'm an advisor and partner at WorthPoint. We can be found at worthpointinvest.com. Apollo, have a great day, and we'll see you on the next video.
Talk soon.